Internal Revenue Service IRS tax news. New FAQs or frequently asked questions available to aid families and small business under the American Rescue Plan. Information for enhanced 2021 child and dependent care tax credits, updated paid sick and family leave credits for Q2, Q2, and Q3, Q3 of 2021. IR 2021-128, June 11th, 2021, Washington. The Internal Revenue Service today posted two new separate sets of frequently asked questions, otherwise known as FAQs, to assist families and small and mid-sized employers. There's links to the families and small and mid-sized employers here in claiming credits under the American Rescue Plan, the ARP, the ARP. Both the Child and Dependent Care Credit as well as the Paid Sick and Family Leave Credit were enhanced under the ARP, the American Rescue Plan, enacted in March to assist families and small businesses with the fallout of the COVID-19 pandemic and recovery underway. The two sets of FAQs, frequently asked questions, provide information on eligibility, computing the credit amounts, and how to claim these important tax benefits. An overview of these credits follows. So we have the Child and Dependent Care Credit. So note that one of the major tools that the government has to be helping out with the individual citizen, the individual taxpayer, is the IRS tax code, the tax law. So that means that some of these changes that are taking place are going to be unique. They're going to be changes that we have not yet seen in the past. Most of them, of course, are designed to be beneficial. However, the fact that they are changes and these changes are taking place all the time or somewhat consistently in the current years makes them difficult, and it makes them different than what has happened in the past. We got to make sure that we're paying more attention to them so that we can be in compliance with our tax obligations as well as get the tax benefits that we are entitled to under the law, as the laws are constantly changing here. So here we have, for 2021, the ARP increased the maximum amount of work-related expenses for qualifying care that may be taken into account in calculating the credit, increased the maximum percent of those expenses for which the credit may be taken, modified how the credit is reduced for higher earners, and made it refundable. So a lot of changes to this credit, the Child and Dependent Care Credit for 2000. Now notice when you're thinking about the Child and Dependent Care Credit, it's different than the Child Tax Credit. Those are two things that sound very similar, but they're two different things. We're talking about the dependent care and the deductibility of the dependent care. So they've made changes to that as well. They've also made changes to the child tax credit. So once again, let's do that one more time. We're on the Child and Dependent Care Credit. So for 2021, the ARP increased the maximum amount of work-related expenses for qualifying care that may be taken into account in calculating the credit. So it increases the opportunity for those expenses, increasing the maximum percentage of those expenses for which the credit may be taken. So that might mean that more people might be able to take the credit. Modified how the credit is reduced for higher earners, meaning when you look at the phase out that happens as your income goes up, more people might be, eligible for the credit due to adjustments to the phase out, and made it refundable. So once again, refundable should be a key term that we're hearing a lot about these days. That means that if your tax liability is zero, then you still might get a, quote, refund, end quote, but it's not really a refund if it's refundable. It's a benefit program. It's not really a tax. At that point in time, you're getting money through the tax code system for it. So that refundable portion obviously is a big change as well. So for 2021, eligible taxpayers can claim qualifying work-related expenses up to $8,000 for one qualifying person, up to $3,000 in prior years, or $16,000 for two or more qualifying persons, up from $6,000 in prior years. So you can take, this is a significant change, and it might be something that people haven't really looked at as much in prior years, because when you're filling out your tax return, if you look at the child tax credit, it's kind of an automatic thing, as opposed to this credit, which is the Child and Dependent Care Credit. The child tax credit is basically just an amount given based on the child. So all you have to do is basically put the child on there, and you've got, the credit will be calculated for you. If you look at the Child and Dependent Care Credit, then you've got to do some added steps to record, the necessary expenses that would be involved. And oftentimes, if you had a lower income threshold, there's some interplay between the child tax, the child tax credit, the earned income tax credit, and the child and dependent care credits often kind of mash up to each other and can cause funny things to happen because they're all, these credits that have phased out income limitations and whatnot and change somewhat rapidly, greatly increasing the complexity when you look at the interplay between them for lower income tax returns. Now, if you had this credit that was not refundable and you had some of these income limitations, then it kind of clashes with the earned income tax credit and the child tax credit. But now that it's refundable, more people might have a situation, and now the income levels have changed, and so the phase outs have changed. So you might be in a situation where you're more likely to be in a situation possibly that you qualify for the earned income tax credit and child tax credit and the child and dependent care credit, even though your tax liability is below zero because they're refundable and so on. So this can actually get quite complicated, but you do have software typically that's available to help you to work out these kind of things. These credits, as they overlap, complication increases. But if you use the software, and you should have free access. Many people in that are below an income threshold typically have access to the software. It can help you with an interview process to fill out what is needed, and hopefully the software can help you with these income limitations, which even tax preparers obviously would have very much difficult doing if they didn't have software to help them, especially with the interplay between some of these credits, which again gets quite complex even with tax returns that you would think would be somewhat simple, given the fact that they're generally the lower income tax returns. Okay, so taxpayers are also required to have earnings. The amount of qualified work-related expenses claimed cannot exceed the taxpayer's earnings. So the amount, let's do that one more time. Taxpayers are also required to have earnings, so that you got to have actual income on there, and that's similar to kind of like the earned income tax credit. So they're trying to incentivize that you have earnings, even though your tax liability might be zero because we said it was refundable. So the fact that you have earnings doesn't necessarily mean you're paying taxes because your earnings may be below the threshold of the standard deduction or something like that. So the amount of qualified work expenses claimed cannot exceed the taxpayer's earnings. So you can't have more expenses than the earnings you have, although you could still have this refundable kind of component to it. So combined with the increase in the 50% in the maximum credit rate, taxpayers with the maximum amount of qualifying work-related expenses would receive a credit of $4,000 for one qualifying person and $8,000 for two or more qualifying persons. When calculating the credit, a taxpayer must subtract employer-provided dependent care benefits, such as those provided through a flexible spending account, from total work-related expenses. A qualifying person generally is a dependent under the age of 13 or dependent of any age, or spouse who is incapable of self-care and who lives with the taxpayer for more than half of the year. As in prior years, the more taxpayer earns, the lower the percentage of work-related expenses that are taken into account in determining the credits. So as your income goes up, the credit goes down. So you got this kind of weird situation where you can't record the expenses above what your earnings are. So you have to have some earnings, but of course, once your earnings go above a certain threshold, then the credit will start to go back down. So we got this, you could imagine a curve going up and then back down kind of with the earnings, at least with relation to the expenses that you can deduct. And then once you hit the limit, like most kind of credits, they'll go back down with this income phase out. So however, under the new law, more taxpayers will qualify for the new maximum 50% credit rate. That's because the ARP increased to $125,000, the adjusted gross income level at which the credit rate starts to be reduced. So that's a pretty significant level. Above $125,000, the 50% credit percentage goes down as income rises. So taxpayers with adjusted gross income over $438,000 are not eligible for the credit. It'll completely phase out, in other words, by that point. The credit is fully refundable for the first time in 2021. So again, that's a huge change, a huge difference, which will have a significant impact, or may have a significant impact, meaning, again, even if your liability has gone below zero, you might still get money, which isn't really a refund. It's kind of a benefit program at that point. So this means an eligible taxpayer can receive it even if they owe no federal income tax. To be eligible for the refundable credit, a taxpayer or the taxpayer's spouse, if filing a joint return, must reside in the United States for more than half of the year. However, special rules apply to military personnel stationed outside the United States. To claim the credit for 2021, taxpayers will need to complete Form 2441, Child and Dependent Care Expenses. You can find that form on the IRS website, and include the form when filing their tax returns in 2022. In completing the form to claim the 2021 credit, those claiming the credit will need to provide a valid taxpayer identification number, the TIN, for each qualifying person. Generally, this is the Social Security number for the qualifying person. For more information about completing the form and claiming the credit, see the instructions to the Form 2441. You can look those up on the IRS website. Just look up 2441 form. In addition, those claiming the credit are required to identify all persons or organizations that provide care for the qualifying person. So then you gotta tell them what the care was, and then who the dependent was that it's related to, and then you gotta say who gave the care. So either if it's an organization, then they should have a number that would identify them. If it's a person, then the number that might identify them could be, their social security number possibly or something like that. So this requires providing care provider's name, address, and TIN. We have the paid sick and family leave credits. The paid sick and family leave credits reimburse eligible employers for the cost of providing paid sick and family leave to their employees for reasons related to COVID-19, including leave taken by employees to receive or recover from COVID-19 vaccinations. Self-employed individuals are eligible for similar tax credits. And that's the confusing part, because when they put these in for these kind of work-related things on a federal level, then how does that play out for a self-employed individual, meaning someone who has a Schedule C type business? You may be in a situation where you don't have any employees, you have a Schedule C type business, but you still might get some benefit from something like this. And that's kind of due to, in part, the IRS treating a sole proprietor as both the employer and the employee. You note that or can see that with regards to the self-employment tax, meaning you're paying, when you pay self-employment tax, kind of like the employer and employee portion of payroll taxes, meaning Social Security and Medicare. So if that's the case, if you're being treated kind of as an employee, then you would think then that you should get some benefits with these kind of employee-related federal things, and usually they're kind of taking that into consideration. So anytime you see some law like that, that question should come into your mind. If you're a sole proprietorship, you should say, oh, there's an employee-related kind of credit thing, benefit thing. Did they make some provision for me as a sole proprietorship, since they're basically considering me an employee of my own business and taxing me as such, with the Social Security? And oftentimes they do, although it can be a little complex to figure it out. So check that out if it applies. The paid sick and family leave tax credits under the ARP are similar to those put in place by the Families First Coronavirus Response Act, the FFCRA, as extended and amended by the COVID-related Tax Relief Act of 2020, under which certain employers could receive tax credits for providing paid leave to employees that met the requirements of the Emergency Paid Sick Leave Act and the Emergency Family Medical Leave Expansion Act, as added by the FFCRA. The ARP, that's the one we're talking about now, amends and extends these credits and provides that leave wages paid to an employee who is seeking or awaiting the results of a test for or diagnosis of COVID-19, or in obtaining immunizations related to COVID-19, or receiving from immunizations, or leave wages that can be eligible for the credits. Whew, okay, that's a long sentence. If you didn't catch all that, there's a link to this in the description, and you can try to read that for yourself. Let me catch my breath here. Okay. Additionally, under the ARP, eligible employers may now claim the credit for paid family leave wages for all the same reasons that they can claim the credit for paid sick leave wages. The FAQs, the frequently asked questions, include information on how eligible employers may claim the paid sick and family leave credits, including how to file for and compute the applicable credit amounts, and how to receive advance payments for and refunds of the credit. Under the ARP, eligible employers, including businesses and tax-exempt organizations with fewer than 500 employees and certain governmental employers, may claim tax credits for qualified leave wages and certain other wage-related expenses, such as health plan expenses and certain collectively bargained benefits paid with respect to leave taken by employees beginning on April 1st, 2021 through September 30th, 2021. The ARP keeps the daily wage threshold that previously exists for these credits under the FFCRA. The aggregate cap on qualified sick leave wages remains at 2 weeks up to a maximum of 80 hours, and this aggregate cap reset with respect to leave taken by employees beginning on April 1st, 2021. The aggregate cap on qualified family leave wages increases to $12,000 from $10,000, and this aggregate cap reset with respect to leave taken by employees beginning on April 1st, 2021. The paid leave credits under the ARP are tax credits against the employer's share of Medicare tax. The tax credits are refundable, which means that the employer is entitled to payment a full amount of the credits to the extent it exceeds the employer's share of Medicare tax. So if that Medicare tax doesn't take care of it, they should still get the benefit. So in anticipation of the credits to be claimed on the applicable federal employment tax return, eligible employers can keep the federal employment taxes that they otherwise would have deposited, including federal income tax withheld from employees, the employee's share of Social Security and Medicare, and the employer's share of the Social Security and Medicare taxes with respect to all the employees up to the amount of the credit for which they are eligible. So this is, if you're dealing with the payroll, hopefully you have help doing this because payroll is kind of complex in and of itself, and these are changes to the payroll. Because remember, what normally happens is you pay people weekly, bi-weekly, semi-monthly, or monthly, and then you basically have to take money from the employee for Social Security, Medicare, federal income tax, and you have your payment that you have to pay on their wages for the payroll taxes of Social Security and Medicare, amongst possibly other things like federal unemployment and whatnot, and state taxes and whatnot. And then you have to pay that to the government. And then quarterly, normally, you have quarterly forms of the 941, which are forms that are just informational forms. They're kind of like the 1040 for an individual, but the 1040 is never exact. So you're hoping for a refund on the 1040. You're hoping for a refund because the tax code is so complex that you couldn't get the tax payment correct if you tried because of that. But with payroll taxes, because it's more like a flat tax, that you can you know exactly what the tax should be. You should be able to pay the right amount of tax as you go, even though you didn't actually do the tax return, which we do quarterly instead of yearly with the Form 941 generally. So then, when you file the Form 941, you don't owe anything usually because you're just going to match up what you actually owed them based on recapping the calculation for the quarter, depending on how many payrolls had happened in it. Compare that to the deposits you made. Hopefully the two line up within a few pennies, and then you're okay and you can move forward. Now, what they're doing here is they're trying to give this credit, this benefit, but they want to give it sooner. They don't want you to wait till you file the tax return. How can you do that? Well, you don't pay them. You don't take your money that you took from the employees out of their wages and the amount that you would pay and give it to the IRS yet. You calculate the credit first, and then you hold on to that money. And so then when you do the filing of the tax return on a quarterly basis, you can take into consideration the money that you held on to that you didn't pay to them because you were anticipating the fact that the credit would be taking place. That's the general idea of it. Obviously, again, that can get kind of complex. So I mean, hopefully you have some help with that, but that's the general idea. So if the eligible employer does not have enough federal employment taxes on deposit to cover the amount of the anticipated credits, the eligible employer may request an advance of the credit by filing a Form 7200, advance payment of employer credits due to COVID-19. So that would be a situation where you're going to say, okay, well, that's great. I get to hold on to what I would have paid them. But what if the credit is actually greater than the deposits that I would be making after the payroll took place for the payroll taxes that I withheld from the employee and my payroll taxes. Well, if you're eligible as a small business in that case, then you may be able to get an advance payment by filing the Form 7200 and then get the money before you actually file the tax return quarterly, generally, which would be the 941 quarterly returns. Okay, so self-employed individuals may claim comparable credits on Form 1040 U.S. individual income tax return. So once again, you have this situation where the self-employed person is going to say, well, what about me? Because like I'm an employee for, you're treating me like an employee. Don't I get the same kind of benefits as an employee of myself, even possibly if I don't have any other employees? Because you're treating me as an employee of my own business, charging me Social Security and Medicare on the employer and employee side. You may have benefits there too, and so you're going to check that out on the sole proprietor side of things. So the tax provisions, there's a link to the tax provisions here of the American Rescue Plan for more information. See other provisions. There's a link to that here designed to help taxpayers recovering from the impact of COVID-19 pandemic. Also see FAQs or frequently asked questions. There's a link to that here on these and other provisions.